Hello and welcome back to Moneycontrol's live stream. You're watching Closing Bell with me, Lovisha, Darad, and joining my colleague Nandita Khemka. Nandita, once again, we're seeing a range-bound market today, and markets did reflect that tinge of weakness throughout the day, despite the Nifty starting the day above that 25,150 levels. So if you look at levels now, Sensex down, ended flat in the red, and even Nifty slipped below that 25,100 mark. If you look at all the sectors, that also nosedived into the negative territory, and advanced decline ratio also showcased that declines have taken an upper hand. Bank Nifty index, that also slipped in the red despite opening with a positive bias. And if you look at some of the sectoral losers, PSU banks and Realty, that was some of the worst hit sectors today. No breather came in from the broader end of the markets too. Small caps that was holding in the green for the better part of the day also turned negative and is down about 0.3%. While mid caps, that also saw sharper selling pressure and it ended with about more than 0.5% cut or so. Nandita, no respite today, but the big boys, which is your ICICI Bank and HDFC Bank, continue to perform well today.
That's true, Lovisha. I think one would have thought that yesterday was the turning point, and we would have seen some momentum today, but that was not to be. We did start the day on a positive note, on a firm footing, but we succumbed to profit taking later on. It's also the Sensex weekly expiry today, so some bit of volatility because of that. But of course, the texture of the market remains weak, haven't really been able to build on the momentum that we saw yesterday. As you rightly pointed out, these banking names continue to do well, but the overall banking universe was under pressure, largely led by those mid-tier kind of banks, the likes of RBL Bank, AU Small. All of these banks are still reeling from their performance in the first quarter, not doing all that well. And Realty as well, as you mentioned, Oberoi Realty kicked off the earnings season for this sector, and hasn't really been very enthusing, so to say, underwhelming sort of numbers, and that is clearly reflecting in the market as well. Let's see, but the good part is that we've managed to hold on to the 25,000 mark, because 24,900, that is being pegged as the make or break level for the bulls, and I think 24,882 was the low that we made yesterday. As long as that is protected, I don't think we have, or even experts feel that there isn't much to really worry about. But yes, 25,000 still on the charts, and we have rest of the week ahead of us, where we have a lot of earnings to watch out for. So let's see. Tomorrow we have some Nifty biggies coming out with numbers, the likes of Infosys, Tata Consumer as well, and some of the mid-cap IT names will also be in focus as they report numbers tomorrow. And even Dr. Reddy's from the Pharma pack will be in focus. But let's take a look at the movers then, Lovisha, from the headline indices, which are the stocks that were hogging the limelight.
All right, let's take a look at some of the top gainers and losers on the Nifty 50 pack. Eternal with about 10% gains, given the brokerages have also upgraded the counter on the back of its strong Q1 results. Of course, we did see a bottom line miss. However, top line was the one which took the show away. And we can see brokerages also upgrade the counter, and they've raised the target price on the counter. So 10% uptick that is coming in for Eternal. And of course, for the second straight day, the counter has gained as well. So in just 2 days, the counter is up about 15% or so, and the stock also notched an all-time high in the trading session today. But yes, we'll be discussing more of that later in the segment too. Other than that, HDFC Life performing well for the second consecutive day with about 1.4% gains. Other than that, Titan doing well on the back of acquiring a majority stake in the Dubai company with about 1% gains or so. Hindalco, Bharat Electronics, some of the other top gainers on the Nifty 50. On the other hand, if you look at the top losers, Shriram Finance down about 2%. We will be watching out for Shriram Finance Q1 results, which is due on Friday. So yes, the stock has been, on the languishing trend ahead of its June quarter results. Other than that, we can see Eicher Motors, Adani Ports and Tata Motors are also some of the top Nifty drags in the today's trading session. However, yes, broader end of the markets that continue to sulk today. Mid-cap and small-cap indices lose up to 0.5% or so. Anything that you're gathering from there, Nandita?
Yeah, the advanced decline ratio, clearly in favor of declines. On the NSE, it was at 2:3. And not surprising given the fact that the small cap index has clocked a 4th straight day of losses, and of course the losses on the mid cap index is also much more compared to the benchmarks. But a couple of counters that stood out were the likes of Mahanagar Gas, Colgate, these are some of the companies that reported numbers. Mahanagar Gas, interesting, the numbers were an all-round beat. Margins also saw an increase, profit, revenue, all of them beat expectations. The stock also jumped 3% post numbers, but by the end of the session, it really failed to sustain all of those gains. Just looking at the stock performance, the last few hours, few minutes of trade rather, ended lower by almost 3%. So that's an interesting, reaction coming into the numbers, although the numbers were good. So we'll see how the street is viewing the numbers and what's the brokerage verdict tomorrow morning. But aside of that, Colgate also came out with numbers. Numbers were pretty underwhelming, and the stock really didn't do much. It was kind of trading in the negative zone, but not really much to take away from. The mid-cap cement pack was buzzing. You had the likes of India Cements, Ramco Cements. These stocks were buzzing. We had Ultratech numbers coming out yesterday. The commentary was pretty solid. The numbers weren't all that good, but the commentary was pretty solid, which had a rub-off impact on the mid-cap cement pack. Tier 2 financials, as I mentioned, were out of favor. The likes of RBL Bank, AU Small, all of these were under pressure. There's a stock called Blue Jet Healthcare. That stock crashed almost 10%. After a sequential miss on earnings. So that was one stock that stood out. Capital market stocks were doing well today, the likes of BSC, Angel One, Nuvama, given the fact that Jane Street has been allowed to resume trading on NSE and BSE, but with conditions. So that's one trigger for the capital market stocks, related themes rather. Aside of that, if you look at some of the other names, RHI, Magnesita, Swiggy of course had a rub-off impact from Eternal. That stock was also up somewhere around 3 to 4%. GMDC, MQ Pharma, these were the other movers. On the flip side, 361 WAM was the big loser. There were a couple of block trades in the counter. So that stock was under pressure. Z came out with earnings, and ad revenue saw a dip, subscription revenue saw a dip. Profit, revenue, all of them were below expectations. Margins were slightly higher, but the stock was down 5%. Aarti Industries, Raymond Life, these were the other movers in trade. So yes, lots of result reactions, and as we are in the thick of earnings season, we can expect more stocks to hog the limelight later this week as well. Tomorrow, of course, mid-cap IT will be in focus. The likes of Persistent, Coforge will be reporting numbers.
That's right. All right, let's also break down some of the stocks that did steal the limelight today. First, let's discuss about Internal, the stock, clearly the stock of the day, and it jumped as much as 14% and also ended the day with about 10% gains, and also hit a new record high after its quarterly results. Now, yesterday also the stock was up about 6%, and today also the stock is doing quite well, double-digit gains coming in for the counter. Now, despite the 90% fall in the profit in the first quarter, top line is where the company found comfort with, as revenues rose about 70% on a year-on-year basis, which was largely led by its quick commerce vertical. Now, revenue from the Blinkit more than doubled, and also its net order value crossed Zomato. Now, this marks the first quarter where Blinkit has exceeded the company's core food delivery arm, showing that there is a shift in more weightage towards the quick commerce vertical. Now, brokerages have raised their target price on the counter, and they believe that the stock can touch up to 400 rupees, which means that, we could see another 28 to about 30% upside from a brokerage point of view. What the brokerages have been saying, Jefferies, for instance, did outline that this high target price, it comes on the back of the positive management commentary, particularly for the quick commerce channel, which marks a shift from the previous quarters. Bernstein, that also shared an outperform rating on the counter, and as this quarter marked a strong beat from the quick commerce perspective, with gross order value rising sharply by about 140% year-on-year, and EBITDA losses turned out lower than expected. On the other hand, we also had CLSA, which shared a high conviction outperform call, and Nuvama also maintained its buy call. Nuvama now basically said in its report that it values both the food delivery and Blinkit businesses at about $16 billion. So yes, clearly an outperformer for today in a subdued market with about 10% gains as well. Off to you, Nandita.
That's true. Of course, year on year there was a dip, but sequential performance was pretty good, and the big takeaway was that Blinkit has overtaken the food delivery business, and of course, analysts also believe that the food delivery business growth has bottomed out, and margins are expected to edge higher from here. So that was about Blinkit and Eternal, and of course also had a rub-off impact on the likes of Swiggy. But let's talk about another stock, Havells. The company's earnings weren't all that great, but the outlook here on from brokerages is pretty strong. If you look at the numbers, challenging. Revenue fell over 6% on a year-on-year basis. The company saw a top-line contraction on a year-on-year basis for the first time since COVID times. So that was the kind of pain the company saw in the first quarter, and that was largely led by softness due to subdued demand in the electrical consumer durable segment. Of course, a Lloyd segment as well. Early onset of monsoon, weak summer, these are some of the factors that weighed in on performance. However, the company's cables and wire segment did well, strong growth, and it was a silver lining, so to say. But now coming to what the brokerages are saying about the stock, Bank of America has double upgraded the stock to buy. Well, the target price has also been increased to 1400 rupees compared to, in fact, from 1400 rupees to 1785 rupees per share, a good upside from current levels. That's because the brokerage believes that the worst, in terms of the summer weakness, streets imminent estimate cuts post the first quarter miss, all of this is largely factored in, and the earnings downgrade cycle could be well behind it. The street in fact has cut earnings estimates by anywhere between 19 to 16% since September last year. Since then the stock is also down somewhere around 25% or thereabouts. Now BofA believes that valuations, because of the correction that the stock has seen, are pretty much favorable now. The risk reward is well looking favorable, and here on the growth visibility should only improve over the next couple of financial years. Now earlier BofA was really cautious on capacity bottlenecks, rising competition in the cable segment, sluggish progress in Lloyd's profitability, weak summer. These are some of the factors that made Bank of America cautious on the stock. But now with these headwinds behind and with valuation comfort, it feels that it does offer quite a bit of an upside from here, which is why it has double upgraded the stock to buy. Valuations, by the way, are down 22% from the peak, and as I mentioned, the risk reward because of that looks pretty favorable. In fact, it also believes that the company is well placed to benefit from the penetration led growth in the AC segment, and of course the strong momentum that it has already seen in the cables and wire segment. Near term impact on Lloyd's is largely factored in, as I mentioned early, onset of monsoon has weighed in on demand for cooling products. AC fan sales have been down somewhere around 30%, 14% or thereabouts for Havells, vis-a-vis expectations of a growth of 15%. Now this has led to elevated channel inventory in a seasonally weak quarter, which is why the performance was extremely weak. But there is a BEE energy rating revision that will kick in from January 2026. Now that could put some pressure on pricing as well. As dealers try to clear their stock. That could be one risk. Last time the BE revision happened, there was a cost increase of somewhere around 7 to 10% impacting margins, which is why some bit of margin pressure can actually be expected. But if you look at the consumer durable space, BofA believes that Havells is well placed, and given the fact that AC contributes just about 30% of its sales. And of course, wires and cable segment, which the company has already seen strength in, is expected to do well, and it is expected to also drive some bit of demand recovery going forward in the second and third quarter as well. So let's see, BofA expects some bit of a festive demand uptick as well, which is why second and third quarter are expected to be much better than how the first quarter has turned out to be for Havells.
That is the stock we need to watch out for. But yes, the management did mention that they are containing higher inventory levels, and that could take some time, like instance 1 or 2 quarters for it to liquidate. So yes, we'll watch out for this counter, 3% up. So that's coming on the back of a positive brokerage report from BofA also. But yes, coming to next stock to discuss, that is your Titan, doing well on the back of the jewelry maker acquisition of a majority stake in a UAE based Damas jewelry in an all cash deal. Now this is a move which helps the Tata Group manage firm to expand businesses in the GCC countries. Now Tata's wholly owned subsidiary, which is your Titan Holdings, has signed a definitive agreement with Manai Corporation for the purchase of its 67% shareholding in Damas. Titan expects that the proposed transaction is to be completed before January 31st next year, and which is subject to, of course, regulatory clearances once the company gets. Now, Damas Jewelry, it has a network presence of about 146 stores across the 6 GCC countries. So basically, this deal is expected to facilitate any of the expansion which is across the mentioned 6 GCC countries, which includes UAE, Saudi Arabia, Qatar, Oman, Kuwait, and even Bahrain. So they want to cater to the Arabian aesthetic designs, and that is why they want to differentiate their products, and that's why the partnership has been. Now, how the brokerages have reacted to it, Morgan Stanley, they have shared an overweight call, and they shared a target price of about 38.76 rupees per share. What they mean is that they highlighted the fact that the acquisition of Damas will be done through debt cash balances, and there would be synergies playing out in the retail network, talent and supply chain as well. CLSA also shared an outperform call, as they believe that this transaction will help Tanishq build its presence in a premium market. So yes, Nandita, margin expansion is something that we'll be watching out for Titan as well, and the investors will be watching out for going ahead in the upcoming quarters ahead too.
That's true. That's about Titan, new acquisition, but let's see how the execution really pans out. But last talk really for the day, and on my radar, large cap IT name Infosys will be handing in its report card tomorrow. Of course, we know that IT hasn't really started off on a good note. Expectations were already pretty subdued. And we've seen what TCS did in terms of top line growth. But when it comes to Infosys, Street is expecting this company to lead tier 1 peers when it comes to the constant currency revenue growth. It is expected to post highest sequential CC revenue growth when it comes to the large cap IT space, so to say. Mind you, till now we've only seen LTI, Mindtree hand in positive constant currency revenue growth, somewhere around 0.8% or thereabouts. All the others have seen a degrowth in the constant currency revenue growth. But in terms of Infosys, Street is expecting anywhere between 1 to 1.6% kind of a growth on a sequential basis. However, outlook is likely to remain clouded, against the backdrop of macro tailwinds as well as delayed decision-making cycles when it comes to clients. But higher billing days and strength in the BFSI vertical are expected to drive top-line growth for Infosys in the quarter gone by. It is expected to raise its FY26 revenue guidance from 0 to 3% to 1 to 3%. So it is expected to tweak the lower end of the guidance, which is what even HCL Tech did. It increased its guidance from 2 to 5% to 3 to 5%. So that's another monitorable. In terms of discretionary spending, it is expected to remain soft, and there could be caution in segments like manufacturing and vertical, as we have seen for the other companies as well. Operating margins are likely to be flat on a quarter-on-quarter basis, and the company is likely to maintain its FY26 EBIT margin guidance at 20 to 22%, which it has been doing for quite some time now. The large deal TCV is expected around $3 billion, but it will be the focus on the quality of the deal pipeline, particularly in the generative AI led or transformational deals. Generative AI is seen as a medium term growth driver for Infosys, but the company doesn't really quantify the revenue it generates from these projects, right? So that's something that the Street will be monitoring, whether or not the company gives some color as to what kind of revenues it's really making from these AI or generative AI led deals. So yes, these are some of the monitorables. But yes, in terms of constant currency revenue growth, we'll have to see whether it manages to outpace its peers, and secondly, in terms of guidance, whether it makes any tweaks or not. But today, of course, the IT pack as a whole was under pressure.
Yes, that's right. This is something that we need to watch out for, because the 5 IT giants that have reported so far, it's kind of muted because of the weak discretionary spends that we saw. But yes, tier 2 companies, that is where we need to watch out for. Coforge and Persistent Systems, something that they will be, reporting their first quarter results as well. Along with that, Tata Consumer and of course Dr. Reddy's too. But yes, that's all the stocks we have for today, and we'll be keeping them under track. More earnings reactions will be coming in tomorrow too. But for now, it's a wrap from Nandita and me, and thank you for watching.